Someone told me there would be max pain on June 19, but I didn't see any max pain. Did you? Here's a quick overview of my portfolio for the week and any trades I made. So as of June 18, my total balance is right now sitting at 97,309. So here are my positions in my margin account. So if you're watching my previous videos, you know that I do put spreads on the SPY every 30 days. Every Monday, Wednesday, Friday, I'll open a new put spread on the SPY with 30 days expiration. But just this week, I decided to try 7 days expiration instead of 30 days expiration. And I closed one of them today. So the one I opened on Wednesday, I closed it today. So in 2 days, I was able to close it for 50% profit. Here, let me show you. If I go under orders, executed, and then filter on SPY. So June 24th. So you can see the June 24th expiration is right here. On June 17, I opened it for 82 cents, collected 82 cents, did 2 contracts, and I closed it today. So June 24th expiration is right here. I closed it today, June 19, for 41 cents. I actually could have gotten a better price if I did it earlier, probably around 35 cents or something, but anyways, closed it for 41 cents, so I made a profit. So basically made a profit of 41 cents times 2 contracts. But then I opened a new put spread at same principle for 7 days. So today we're Friday. I went for expiration of next Friday, so June 26th, but the expected move was at about 305. I did this one, the SPY was trading at 314. And then I didn't know, of course, the SPY was going to drop today. It dropped all the way to 309, 308. And even after hours, the SPY is trading at 306.8 after hours. So I opened it today, expiring June 26, collected 76 cents, I think, or 77 cents. Here, let's go back to orders, executed. So SPY June 26, yeah, collected 76 cents with a 305 short strike. So now I need SPY to stay above 305 come next Friday. It's trading at 306.8 right now after hours, but who knows, on Monday it could be a different story completely. But yeah, that's the risk that I'm holding right now. But guess what? If it's still down on Monday, I have another put spread that I'm going to open on Monday, from Monday to Monday, and this time I'm going to open it with SPY trading at 306. So my short strike is definitely going to be a much safer short strike, probably around 295, even lower maybe. So my next trade is going to become safer, even if this one is a bit tested. But the idea now is, how do I control the losses on the existing put spread? So I think if I can just manage the losses on the existing put spreads, this strategy overall can be very profitable. So for example, maybe I should just close the trade completely. Like if I don't feel good about it, maybe I should just close it. And if I want, I could have closed it today for $1.60. So I would have lost about maybe $1 per contract. I did 2 contracts, so it would have lost maybe $1 per contract instead of losing more. But I mean, it's close to being tested, but it's not tested yet. So maybe it's safe, and maybe it's a potential winner. So maybe I shouldn't touch it yet. So that's always a concern. So for sure, I'm not going to do anything to it right now, but potentially I could maybe sell a call spread against it, or even at the same strike as the put spread. So turning it into an iron butterfly. I still have a July 13, 285, 280 put spread. It's always, today it was actually very close to being closed at 50%. I didn't close it. It was like 2 cents or 3 cents away. I didn't close it, and definitely should have closed it, because right now it's back up to, maybe I was supposed to close it for around 40 cents. I think right now it's trading for 64, almost 85 cents. So definitely missed out on not closing it today. I've got this July 10 Iron Condor now. It was initially put spread at 304, 299, but then when the SPY got tested, when the SPY reached 298, I sold a call spread at 315, and now the 315 was getting tested. The 315 call spread was getting tested, but definitely not getting tested right now. So maybe I could try to close this whole trade for something good. See, if I try to close it right now, I would have to pay $3.60 about. I collected $1.80. I collected $1.80 from this trade. So if I close it right now, I would lose $1.80 if I close it as is. But I'll hold on to it. Hopefully it stays within that range as we get closer to July 10, and maybe I can close it for a profit, or maybe even break even. I've got this July 6th Iron Condor. Once again, initially was a put spread at 303. When it got tested, I sold a call spread at 320. Right now, if I want to close it, I could close it for about $2.70. So once again, I'm going to hold on to it. I won't do anything, but the plan is hopefully SPY stays between 320 and 303 as we get closer to July 6th. And I've got this July 8th iron condor as well. It was a 305 300 put spread that got tested, so I sold a 323 328 call spread. I should probably move this call spread lower. I should bring it closer now because we're getting closer to July 8th. The call spread is probably profitable. I could close the whole trade now for $2.50. I think I collected about, $1.10 with this trade, so it's not ready to be closed. Like the other two iron condors, these ones I'm just gonna hold on and just hope SPY stays in between, and if it surpasses one side, then I'm gonna bring the other side closer to collect more credit and just avoid max loss, trying to reduce max loss, and hopefully my new put spreads compensate for these losses. So why do I insist on selling these put spreads on the SPY if they're always getting tested? The reason I like them is because I don't have to guess direction. It always gives me a room, gives me margin to be wrong, gives me space to be wrong, and I could still make money. And even if one of them gets tested or I lose on one of them, the next one has a better chance of winning, because that's the beauty of put spreads, is when the market falls, premiums go up. So if premiums go up, I collect more on my next put spread, plus I can go even further, making the trade safer. And the general direction of the market anyways is to go up. So when a market already dropped, usually it has already dropped. It's not going to continue dropping, usually, I say. So it makes it even, it's like a self-hedging strategy. But I'm going to continue with the 7 days, see how it goes for a bit. I like the fact that I was able to close in 2 days my Wednesday put spread, and the SPY didn't even move away that much from the price that I initially sold my put spread. When I initially sold my put spread, I think the SPY was at 313, and today I closed it while the SPY was at 313 as well. So just because 2 days passed, I was able to close my put spread for 50%. So in my TFSA, I rolled my covered call, but I rolled it to the same strike of 213. I collected a credit by rolling. I initially had here, if I go to orders executed, I initially had a June 26th expiration, so next Friday, 213. But there was no time value left in that option, so I was afraid to get called away or exercised, so I decided to roll it. So I went from June 26 expiration to July 17 expiration, but I kept the same strike. Ideally, I would like to move the strike higher to get closer to the current market price, which is about 245. But I couldn't for a credit, so I stayed at 213 and I collected 90 cents of credit, or $90. So I'm gonna keep rolling for credits until the Qs decide to drop back down. I do have 34 shares on the side here of the Qs that are not part of a covered call, so this one's not capped to the upside. So this one's taking advantage of the crazy price of the Qs. So it's showing a $785 profit. So this one's capped to the upside because my cover call is at 213. So that limits my selling price. I can never sell above 213. So I don't take advantage of the 244 price that it's trading at right now. Not only that, but my cost on the Qs is 221. So I'm losing money between 213 and 221, but I've gained a lot of credits. I've sold a lot of credits on this position. Plus I'm making money on these 34 shares. So hopefully maybe what I make here compensates maybe for the difference between the 213 and the 221. That's assuming if the Qs never come back down, but I think it should come back down eventually. Hopefully it comes back down to something near my strike. Actually, I downloaded the activity just to see how much I've collected in premiums or in credit from these covered calls. So I actually collected about $1,079 in premiums from covered calls on the Qs. And these are premiums that are mine. I get to keep no matter what happens. And that doesn't include the $90 of today. So it's about $1,170 that I've collected in premiums. $1,170 that I've collected in covered call premiums from the Qs. In my RSP, I've got my covered call on the Qs. I've got 100 shares of IWM that I bought at an average price of 151. Now IWM is down, so I'm down on the shares about $1,000. I've got 37 shares as well, average price of 151. So I'm down on those ones as well. But I've been selling covered calls on IWM, out of the money weekly covered calls. And the last one I did here was June 19th, so today's expiration, at a 146 strike. And actually this strike, the 146 strike, was tested at the beginning of this week, I think on Tuesday. But then it dropped back down and Thankfully, it expired worthless because right now IWM is trading at about 140. So as you can see, it's worth a penny now. So it's going to expire worthless. And then on Monday, I'm going to sell a new covered call on IWM. And I'll try to go as far as I can, maybe 152, 153, or 154, and try to collect maybe $30 or 30 cents of premium. And I've also downloaded the activity for this one just to see how much premiums I've collected in total from IWM. So yeah, it shows here I've collected about $506 US in out of the money covered calls on IWM. So this is premium that I keep. I don't ever have to give it back. So I see this as the dividend kicker, an extra dividend, because actually IWM pays about 2% per year in dividends. And if you take this 506 and divide it by, now this is in how much time? So if we look at the transaction date, so started in March and we are in June. So about 3 months, okay? So I collected about $500 US in 3 months, and I put in about $15,000 in capital, right? So 500 divided by 15,000, this is my cost, is 3.3% in 3 months. This is extra premium. This is extra income while holding the stock. Times 4 just to annualize it. So that's like a 13% dividend yield by selling out of the money covered calls on my position that is actually down. My shares are actually down in value, but I just collected the equivalent of 13% per year of dividends and the stock pays another 2% per year in dividends. And it was eventually did come back up above 151, but then dropped back down quickly. So eventually my position will recover. So I'm not too worried about the shares being down at all. My only concern is losing my shares at a lower price by selling covered calls. So when I sell covered calls, I limit my upside. So that's why I try to sell weekly covered calls, and I try to make sure I go as far as possible so that there's a less chance it gets exercised and I lose my shares at that price. But eventually when IWM will be trading above my cost price, then I don't care if I lose my shares at a higher price, because as long as I lose it above my cost, it's not going to be a big deal, and I can keep rolling anyways. I can buy it back. I can buy back the call option and sell another call option for the following week, making sure that the net transaction gives me a credit. And in my RESP, still got my MasterCard 6 shares. They keep going up and down in value. Right now shows me a $124 profit. It's not something I plan on selling anytime soon. And I've got Dell. I rolled my call option to October, collecting $200 of credit. So I also collected some decent credit on Dell, probably almost close to $900 probably, but it has an expiration of October 16. So I'm in the trade until October 16. But I was actually thinking of getting out of it and buying Intel instead. I like Dell, but I think Intel, I'm thinking of doing a weekly covered call trade on Intel. I think I could probably collect more premiums if I do that every week, selling a covered call on Intel. So for example, if I look up Intel right now, INTC, and I look up the covered call trade, and I go for June 26th expiration. See, I just make sure there's no earnings first. Earnings is July 23rd. Okay, I'm good. So it's trading at 59.6 right now. I could get into this covered call trade, for example, over here, 58 strike, and I would pay about 57.20 cents. So in 1 week, I would make about 80 cents in profit as long as Intel stays above 58. And if I keep repeating that, let's see annualize what it would give me. So if I can buy this covered call trade for 57.2, right? So the max I can sell it for is 58. So 58 divided by 57.2, it gives me a 1.4% return per week. So if I annualize that, that's going to be over 60% per year, right? 1.4 times 52, that's 72% per year. But obviously not every week is going to be good like that. There might be times where Intel drops below my strike, so then in that case I would lose. But I think if I give myself 52 occurrences where I sell in the money covered call so that I get my capital back, then, but this way I won't be taking advantage of any capital appreciation. So that's the downside. I miss out on capital appreciation, but I keep collecting premiums from Intel. And the reason I would prefer to do that over capital appreciation is if you look at Intel right now, let's look at the past 6 months. I mean, it moved a lot, but right now at over 6 months it's at the same price. So if I just bought and hold Intel without doing anything, I'd be kind of annoyed right now. Buying and holding, you really have to wait over 15-20 years to really take advantage of that. But in the short term, sometimes buying and holding really is annoying. But if I do every week, try to collect premiums from Intel as much as I can every week, some weeks will be good, some weeks will be bad, but most of the weeks should be good. And I think I would generate more premiums that way as long as I'm consistent. All right, so this was a quick overview of my portfolio. So if you have any questions, any suggestions, any comments as well, leave in the comment section below. I'm open to all feedback. And like always, if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back depending on your deposit, and the other one gives you $50 in free trades regardless of your deposit. And if you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.